Can you show me different options of whole life insurance policies designed for maximum cash value? Can you reverse engineer the math on a whole life insurance policy that is designed for maximum cash value? Can you explain dividends, internal rates of return, both the annual and average on cash value, and also the death benefit? Can you go as deep as I want and answer every question with respect to a whole life insurance policy before I dedicate any amount of money to that product? Have you ever asked these questions? We hear these questions quite frequently, but recently I met with an individual who I liked a lot. He had been doing his research on whole life insurance, and he had very, very specific questions, very similar to the ones that we started this video with respect to cash value life insurance products. So in this video and the videos to follow, we are going to look at a case study and really go through a deep dive of different whole life insurance products, companies, how to maximize the long-term cash value, the long-term death benefit, and really what this individual was looking for, and then the options we showed him, the questions he asked. We're going to have some fun with this. So what we will begin with is the groundwork, and I'm going to provide detail on this. So to set the groundwork, I have met with the husband primarily thus far, which we discussed taking a policy out on him, his wife, a combination of both, and quickly came to the conclusion that a policy on his wife will provide a greater overall value with respect to the cash value performance, just being that she's a healthy female, a little bit younger than him, and the death benefit being paid to him or vice versa with respect to income protection. So if you take a policy out on your wife, or if you're watching this, you take a policy out on your husband, if they die, a death benefit is paid out to you, the actual life insurance benefit. This isn't important to them, or it's not super important, I should say that, because they have substantial assets, they've got healthy income. They're saying, hey, from a death benefit perspective, money coming back to us for income protection is not really our priority. From an estate planning standpoint and leaving a legacy, absolutely that is a focus of ours. But the immediate death benefit, not really. So how do we, one, maximize the cash value? That constantly came up. But two, maximize the long-term death benefit. And we came to the conclusion that a policy on her would be the best option. We did consider a survivorship policy, but based on the funding option she was considering, or they were considering, that doesn't make sense just because a survivorship policy has different MEC limits and such. So when you use a term rider and reduce it, you've got a higher risk of a long-term MEC without getting into details on that. That's why we looked at a policy on just her in this particular case. The survivorship may come up in the future as we progress through our conversations. A little bit of background. So the wife is the CEO of a software company that serves the banking industry. Prior to that, she was a CFO at a different software company. The husband knows software, has worked for software companies. When I talk to him, I feel like he's got an engineering background, also invests heavily in real estate. They are numbers people, very focused on the numbers, and that's what their point of interest is. When I pay any amount of money in, what does the product look like, and how do I maximize the cash value? That's my point of interest, Steve. So we're going to focus on that. Some questions he asked. What does the annual internal rate of return look like on cash value? What does the average internal rate of return look like on cash value? What does the average internal rate of return look like on my death benefit as the years pass? So a little bit of information on the annual and average internal rates of return. If you're interested in a policy for maximum cash value and you're trying to figure out what is it actually growing by each year, this is what we want to ask for. The internal rate of return represents your net growth rate. Where there's confusion in the industry is often we see a credited dividend rate associated with the life insurance company and policy, and that dividend rate is a gross rate. Prime example. Company can have a dividend rate of 6%. There's no chance that I'm actually earning 6% with respect to the dividend. My net internal rate of return may be closer to 4% in that case. But he wanted to see the annual internal rate of return. The annual internal rate of return isolates what you are earning each particular year. A great illustration is, what did you earn last year in the stock market? Last year, the market boomed and I earned 30%. That's what I earned annually during that particular year. What did I earn over the past 30 years? What was my average internal rate of return? Well, again, using the stock market as an illustration, I averaged 8%, 7 or 8% over the past 30 years. So the annual isolates each year. The average internal rate of return is the average over any study period. If I look at 10 years, 20 years, 30 years, we looked at it over the life of the policy. Same thing with respect to the death benefit. You'll notice it starts at very high and then gets lower over time. As I pay more money into it, the internal rate of return on death benefit will decrease, and we'll walk through the numbers when we get to that. So the funding that they're considering initially is a $1 million lump sum. And a concern that he had expressed, he sent a list of questions, which I appreciate. Whenever we get a long email or a document with questions, what we strive to do, I've always made it a point to do this, is one, provide a written response, if possible, with documents, data points that back it up. And then two, also a verbal response over a call or it's a recording, just to make things very, very simple for the end user. In this case, the individual interested in a high cash value policy. But initially interested in moving a $1 million lump sum, money sitting in the bank that is not earning anything. He wants to be able to use this for real estate. He can do that in the bank, but it's not earning anything. He wants to get it out of there. He does not consider that safe money in the bank account, in his bank account. That's his preference. So before just taking that and running with it, a question I asked here, and this is a good question to ask the agent you're working with. If you're working with us and don't ask it, a lot of times we'll ask it for you, is aside from the lump sum, do you want to add more money to the policy? So for example, a lump sum on a 49-year-old female, the most efficient funding time period will be breaking that up over 3 to 4 years. Just at her present age, we ran everything at regular preferred, even though she'll likely get preferred plus the top class, we ran it a bit more conservative. But after that lump sum, let's say we go $250,000 per year for 4 years, just to run things conservative. After you get that $1 million into the policy, Mr. or Mrs. Client, do you want to add more money? And his response was, I don't know. And that is a perfectly valid response. We might know, we might not know, but when we get the answer, I don't know, what I want to do in that particular case is think, okay, if I'm you, if you and I flip positions and you asked me, hey, after you move your $1 million into a policy, Steve, do you want to add more funds? And I say, I'm not quite sure. Well, here are the options that I would want to see, just knowing what I know, being in the industry, to provide full transparency or awareness in this case. Option one, show exactly what he's interested in. The $1 million going into a policy and then stopping. Not going to pay another penny into the product after that. The most efficient strategy, especially when we run a more conservative dividend interest rate, is breaking that lump sum up over 4 years. Based on the non-guarantees, 3 years would actually look better with most products. However, again, if we run things conservative and scale that dividend interest rate back, MEC test the policy, all of the important small steps that have to occur in the back end, 4 years are most efficient. And then we'll go through the pros and cons of that. That's option one. Then option two, if the answer is I don't know, is, well, what does it look like if you keep funding? And not only what does it look like if you keep funding at $250,000 per year, he might say, hey, aside from the million, I'm not going to keep pumping $250K per year in, but I'll show that in addition to showing an option where I pay maybe just $50K per year thereafter, up to $250, showing that you have a range. Then we'll also show different products. So on that point, actually, we want to build awareness and show both options. And to give you a flavor of what we showed here, 2 different companies, MassMutual and Guardian. Now, since the 7702 update occurred, there's more products and more options available because the game has changed a bit with respect to cash value life insurance, guarantees, MEC limits, all that fun stuff. The game has changed. You can tell we have too much fun with this stuff sometimes. So, with MassMutual, ran 3 different options. Their 10-pay product. With the particular design, my goal here was maximizing the internal rate of return. Among the different MassMutual policy options, if you design this correctly, this will give you the highest internal rate of return. What you sacrifice with it, though, is a lack of flexibility. Typically with MassMutual, if you design it properly, utilizing their lister rider and such, you can easily make payment adjustments 1 time per year, every year without any medical underwriting, provided that that 1-year term rider is still attached. And you can do that with the 10 pay, but it forces a higher base premium and sacrifices the internal rate of return. It's not as strong as what it could look like. So what we did was design a 10 pay product with no flexibility. So if he says, hey, I just want to get the $1 million in, it's sitting in cash right now, I don't need flexibility. Like I can easily write a check for the $250 or any dollar amount each year and get it into the product, then that can be a fantastic option. So I want to provide that. After 10 years, can't pay anything into it. 15 pay policy. So this has an IRR that's attractive. It's not quite as attractive as the 10 pay policy. However, it's usually 0.1 to 0.15% lower than the 10 pay. However, what you get, so you get a little bit weaker internal rate of return, but the trade-off is this. You can design the policy where you can easily make payment adjustments one time per year, and you can continue to feed the beast, call it. You can pay into it for a total of 15 years. So the weaker IRR, 0.1 to 0.15, can be significant on a larger dollar amount. And again, the thought process I want to progress through here is, if it is me and these options are available, yes, this one's going to show the best numbers, but the flexibility isn't quite as strong. And he expressed, I don't know how long I want to pay into it. So I don't want to make an assumption from one call and a couple emails therefore, one Zoom call we had so far, that, hey, I think the 10 pay is going to be best for him. Show the different options. And it gets to a point where we've got to show everything, but then still keep it condensed and transparent, easy to follow, which you'll see that in the next video. But we showed that. So those two options, which with MassMutual provide the strongest overall internal rates of return. And then their high early cash value product, which provides rich cash value up front. He wanted to potentially use this policy for real estate. You'll see that in his goals here shortly. But that provides rich cash value up front. What it also allows with this product, and you're going to see this, we're going to show the $250K for 4 years going in, a total of $1 million. But then what does it look like if he decides to keep on pumping money into the policy for a total of 15 years or even a total of 30 years? A nice advantage to MassMutual, if you design the policy properly, is you can continue to pump a high dollar amount into a policy. You can go with a 10/90 split and keep feeding it with rich cash values up front and fund a lot of money for a long period of time without a MEC, without having to go through underwriting again. The only drawback there is how often can you make payment adjustments? One time per year on your anniversary date without any medical underwriting. And there's more flexibility to it. MassMutual's got a lot of PUA rules, but options here. And this is phase one when we start to show him everything. Now, a lot of information we've covered thus far, right? I'll say this, we do not go this deep with everyone, but I do like to ask the question when I'm meeting with someone and they're asking questions, we're having a conversation, and they ask something about the internal rate of return or different product options. I'll ask, would you like the details? Like we can really go through the nitty gritty and show, call it how the watch was built, or you just want to see what time the watch tells. And everyone's different. A lot of people like to see how it's built, and I enjoy going through all the mechanics there. There's a larger time investment, but it is fun because I can really understand the product and what's happening with my money. It's a big issue in this industry, in my opinion, just because of a lack of transparency with cash value insurance. But that's MassMutual. And then Guardian, they've got a number of products. We looked at their L95 policy, and we showed the option one, moving that $1 million lump sum into the policy over 4 years, and then also what it looks like if he paid a reduced amount, about $50,000 per year, beginning the 5th year. With Guardian, their sweet spot is if you said, hey, the max, let's say I set my MEC limit at $250K. If I were to max that out for 5 years and then stop, or 5 years and then pay just the premium or a premium and a reduced PUA, you can really optimize the internal rate of return. If I want to pay in $250K per year and I want a 10/90 split, so a 10% base premium, which is about as low as they'll allow, I can go a little bit lower with Guardian. What I cannot do is fund a policy for 30 years like I could with MassMutual. If I want to fund a policy with a 10/90 split with Guardian, I'll have to go with a higher base premium, which will sacrifice the upfront cash value, break-even point, and that might not be attractive to me. Showing both options is the best thing to do, but kind of see where I'm going here with the different options. So this way he can see everything up front, because he's very, very technical guy, wanted to see everything, start broad, kind of like you go to Amazon, you see all the product offerings, and then start to narrow down. You save the web page of the product that you like the most. That's usually what I do. I bookmark that, or I'll put that in another tab, and then I'll come back to that because that's my main focus after I've browsed everything already. So with this product, we're going to show the guaranteed values, dividend values, and then also what it looks like if he uses that indexed rider. And we do the same with these, but typically when I start, because this is a lot of information to begin with, we'll show something like the non-guaranteed with these, guaranteed only here, and then we start to narrow things down. If it's Mass Mutual, for example, then we start to show the guarantees and everything with the product that the individual is leaning toward. So the advantage to Guardian is really in their flexibility, the convenience factor, where what you can do if you have a Guardian policy with this type of design is you can easily commit to the minimum premium of $25K. That can be the premium and the term rider. It might be a little bit higher. And then 100% at discretion, he can just throw more money into PUAs on an unscheduled basis. That could be through his mobile app, online portal. He can mail in a check. He can do it every week. Very, very flexible when you look at the PUA payments there, with Guardian's PUA rider specifically. But again, a lot of information, a lot of awareness, very technical individual, so we had some fun and made sure we provided all the information. You can tell when someone says, had some fun talking about cash value life insurance, you know you're talking to a weirdo that really likes life insurance policies. And that's me making fun of myself. So some other things that he asked for here. He wanted clarity. He had several additional questions, which we'll get into when we look at the case study. One was around dividends. A big point of frustration, and this has happened with so many people, is just how the industry markets whole life insurance, what people believe it is. You've got the cash value aspect. When you look at the cash value in a life insurance policy, what are the core benefits? Safe area, not invest in the market, will produce a net internal rate of return of 3 to 5% if it's designed properly. So safe. Number 2, liquid. I can access that money anytime. And then 3, tax-free if I don't trigger a modified endowment contract, cash the policy out with a gain, if I don't trigger a taxable event, which is easy to prevent. But that's the benefit. That's what attracts people. Then what you've got is dividends. If I were to Google search a company's dividend interest rate, say for 2022, Mass Mutual, 6%. Guardian, 5.65%. If it's Northwestern Mutual, 5%. You can take any company out there. Most companies disclose their dividend rates. Some don't, but most do. The bigger guys always will. So if you see a dividend rate of 6%, do you feel, take this for example, if you had $100,000 in cash value, dividend rate of 6%, what should you earn? 6% of 100 grand is $6,000. Doesn't work like that. And this was a point of frustration. He understood it, but his question is, why does the industry market like this? Why would they tell me 6% dividend? Because common sense is going to tell me if I've got 100 grand, that's $6,000. Like that's just an interest rate when I see it. So it's terminology, compliance with the insurance industry, all that stuff. A dividend rate's a gross rate. What we always want to look at is the internal rate of return. That simply depicts your net growth rate as the years pass. That is the key there. The illustrations, wanted to go through line by line. What do these illustrations, these different columns and terms mean, which I'll always go through with anyone. The nice thing is too, we've got video content, call it video assets, that we can provide that are pre-recorded with different companies where people can see that, and that usually alleviates questions there. Net internal rate of return versus net loan rate. This is huge. It kind of goes back to the dividend where people feel like it's not transparent, the industry, because it's not. But the net internal rate of return, what did my policy actually grow by this year, over the past 10 years? And then when I borrow, what's the actual cost to borrow? And am I earning more than what I'm paying in loan interest, or is it vice versa? If that's the case, what's a nice alternative? And you will see a workbook on cash value collateral loans. A lot of information here. Another thing he asked actually, which is a good question, which I could only partially answer, is he asked for historical performance. And the specific question was, do you have policies, not dividend history, but policies from the 50s and 60s and what they actually produced? And my answer was, I don't. Not from the 50s and 60s. The oldest policy we have that documents the actual internal rate of return was a policy issued from 1975 with one of the major mutual carriers. That's the oldest one I have. Then we've got policies in the 1980s, 90s, early 2000s, 2010. Gets easier from there because then we study the policies we wrote. But that's as far back with respect to what I have. Anything further back, I would need to try and get from the insurance carriers, but let them know that. Here's how far back we go. Here's the information provided our historical performance playlist, and that way he's got some actual data, not just dividend history. Important to touch on that. And then why he wants to use the policy. We touched on this, real estate, what he's involved in, the husband, and that's his thing. He really enjoys that. So what we're going to look at is, how can I use my cash value life insurance policy? One, to beef up the cash value so I've got access to as much capital as possible. But then two, how do I leverage it in the most efficient way to acquire real estate instead of using cash on hand in the bank? What is a better option? Going through the pros and cons there, because there are disadvantages to this strategy, particularly upfront. So I just want awareness on that before I actually start. Cash value collateral loan, we're going to look at that. A question he asked that I absolutely loved, because no one had asked me this before, was, what's the break-even point look like when I account for loan interest that I'm paying, since loan interest payments are technically out of pocket? Because when I just look at the policy and juice it for cash value, my break-even may be between years 4 and 5. However, if I'm laying out additional out of pocket toward loan interest, I do consider that a cost. Regardless of how I look at it or anyone else, that is how he, the policyholder, potential policyholder, looks at it. So I want to account for that just to provide more transparency. Does it make the product a little bit less attractive in some respects? Yes, but it doesn't matter. It's not my money, it's the policyholder's money. So you've got to be upfront with this kind of stuff. So we are going to go through that as well. That'll be a lot of fun. So a lot of info here. We didn't even get to the numbers. We're going to touch on that in the next video. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.